Markets are moving fast, and who has time to read headlines all day? I know I don't. This is why I created Rushing, the first audio podcast that delivers simplified news for busy investors. This is made by a woman who trades and talks straight to the point. Hi, I'm Yuna, and in the next few minutes, you'll get what's moving the markets, why it matters, and where money's flowing. Everything is fast, smart, and reliable. Let's dive in. First headline: Fed signals more rate hikes possible. What does it mean? Chair Powell hinted the Fed may not be done tightening as inflation remains sticky. Treasury yields rose, pushing borrowing costs higher across markets. Investors reacted with caution, sending tech and real estate stocks lower while defensives held up. Why magnify it? Higher yields shift valuations across the board. Rate-sensitive assets like tech, growth, and housing feel the pressure first, while cash-heavy and dividend sectors gain favor. Possible affected sectors: treasuries across the curve, tech and software, real estate investment trusts, utilities, consumer staples, and the US dollar. Second headline: Tech earnings mixed as consumers. Cool, what does it mean? Big tech earnings showed a split story. Alphabet and Microsoft beat expectations thanks to strong ad and cloud revenue. Apple missed as iPhone demand softened and China sales slowed. Despite the mixed picture, tech indices remained resilient. Why magnify it? Earnings season shows AI and cloud are still the core growth engines, but consumer hardware is softening. The market's next move depends on forward guidance more than on headline beats. Possible affected sectors: megacap tech, semiconductors, AI and cloud infrastructure, consumer electronics, and digital advertising platforms. Third headline: Oil surges on Middle East tensions. What does it mean? Crude prices spiked more than 4% after new geopolitical clashes in the Middle East disrupted Red Sea shipping lanes. Brent crossed the $94 mark before easing slightly as traders reassessed supply chains. Why magnify it? Higher energy prices can reignite inflation fears and tighten financial conditions. They also tend to trigger rotation into energy equities and commodities as hedges against macro shocks. Possible affected sectors: energy producers and refiners, airlines and transports, industrial commodities, inflation-linked bonds, and EM currencies tied to oil flows. Fourth headline: China growth data disappoints. What does it mean? China's GDP and industrial output came in below expectations, showing that post-pandemic momentum continues to fade. Weaker exports, slower property recovery, and soft domestic demand weighed on growth, fueling speculation about additional stimulus. Why magnify it? When China slows, global demand for metals, oil, and manufacturing goods follows. That ripples through global earnings, shipping, and commodity-linked currencies. Possible affected sectors: industrial metals and mining, global manufacturing, shipping and logistics, emerging markets, and energy commodities. Fifth headline: Crypto regulation tightens worldwide. What does it mean? The UK and EU rolled out tougher digital asset rules targeting exchanges, DEFI, and stablecoins. Markets braced for similar signals from Washington. Bitcoin and Ether stayed volatile, with traders weighing regulatory clarity against liquidity fears. Why magnify it? Regulation changes the risk profile for crypto assets and their traditional counterparts. Institutional adoption depends on legal certainty, but overreach could suppress innovation. Possible affected sectors: crypto exchanges and miners, payment processors, blockchain infrastructure, fintech platforms, and high beta risk assets.